Hello and welcome to this edition of All About Your Company. I'm Harsh Saita. Today we're going to be talking about Filatex India. Two reasons or three reasons why this one is an important conversation to have. First off, you've seen crude derivatives, and this one depends entirely on crude derivatives. It's a yarn manufacturer and therefore direct dependence on crude. You've seen a bit of a spike with regard to crude prices over the last month or so. What's the impact of that? At least not visible on the Q4 numbers, which were impressive. Margins have actually gotten better, FY26 versus FY25 by nearly 200 basis points, which is large in terms of the impact itself on the company. That's one. The second one is the fact that this is a 2,000 crore market cap company. They're doing nearly 700 crore, which is 690 crore precisely, of capex. And this will lead to a large EBITDA increase going forward. The timing of it, the manner in which the phased EBITDA increase will happen, we'll try and understand all of those factors, and most importantly, how are they going to fund the 700 crore rupees of capex? So a lot of those nuances and around the next levers of growth. Also, of course, you have India, EU, India, US. As a yarn manufacturer, there's a direct correlationship with consumption in the West versus manufacturing here. And this is a comprehensive or a one-stop shop integrated manufacturer of yarn plus finished product, and therefore will be interesting to see what the management has to say with regard to FY27. But let me take a bit of a step back, give you an overview. It was incorporated in 1990, manufactures polyester and polypropylene, filament yarn and polyester chips. Market cap 2,000 crore, a part of Bulgaria Group, which is the promoter group. Let me now talk to you about the products and some of them. Polyester chips, these are tiny plastic pellets. It's the starting ingredient for polyester yarn. Talking about products now, that's the first product there. Largely consumed internally, very small, maybe 0.5% in terms of its composition to overall revenue, and therefore not even meaningful. But in terms of internal consumption, it's meaningful. Now, the second one is the more important one. Partially oriented yarn. Now, this is essentially polyester thread that's been stretched but not entirely finished. It's only stretched halfway. It needs more processing before it can become fabric. It's basically an intermediate sort of product in the manufacture of textiles or final textiles. It's sold to texturizers who convert it into finished yarn. Now, the third one is fully drawn yarn, which is FDY. Fully drawn yarn is a polyester thread which is stretched to its full extent. Think of it as the final product itself, goes straight to fabric weavers who thereafter use it for the manufacturing of textiles directly. Then there's drawn textured yarn. Drawn textured yarn is a POY, which is partially oriented yarn, but it's been twisted and heated to make it soft and crimp, make it feel like cotton even though it is polyester. And the final product most widely used is in garments, knitwear and sportswear. That is where drawn textured yarn is used. Then there's a separate product category, something like air textured yarn. The previous four products are the core products of the company. That's where a bulk or nearly 99% of the revenue really comes from. And then there's air textured yarn, which is POY blasted with compressed air jets. It's just a different process entirely, which is used and this is basically used for denims, upholstery, curtains and automotive fabrics. Then you have polypropylene filament yarn, which is a thread made from a different plastic, not polyester, it's lighter. There's moisture wicking, odor resistant. The final product is used in sports socks, thermal innerwear, medical textiles, just for perspective and context. There's narrow woven fabrics, small strips of woven fabric like clothing. These are used for waistband elastics and the like. I mean, for example, your bag will have a strap, and that strap is narrow woven fabric. In terms of some of the other products, there is monofilament yarn as well, which is one single strand of synthetic fiber, which is used for the likes of your fishing lines, your toothbrushes. That's where some of the monofilament yarn is used. This is the primary product with which the company started its business, monofilament yarn. Ecosys which is recycled polyester. It's about taking existing polyester which has been discarded, going through a depolymerization, thereafter extracting raw material and remaking the entire polyester again. So, and this is used by certain global brands. So Ecosys is the name of the entity which they've incorporated for the recycled polyester, and a lot of the global brands attach themselves to recycled polyester in their product. This is where the recycled polyester really comes from, and this is where Filatex India stands out, because they are able to manufacture that. Very few competitors in this space, but there are a couple of listed players. Of course, Filatex competes with Reliance Industries, the behemoth, of course, on the polyester side of things otherwise. That's the split with regard to revenue, FY26 product split. Partially oriented is POY, which is around 27%. Then there's drawn textured, which is roughly 40%, and there's fully drawn yarn, which is roughly 30%. The others is very, very small, as you can see. Just about 3% of the revenue is lying and sitting with others. Now, let me talk about the manufacturing process itself. You use crude oil chemicals, thereafter convert that into molten plastic, into polyester yarn. Chemicals used are PTA, which is purified terephthalic acid, and MEG, which is monoethylene glycol. Both of those are melted into molten plastic through a tiny hole at a high speed. Polyester yarn is the result of all of that happens there. There's an integrated facility in Dahej, Gujarat, where all of this happens. In fact, they follow the continuous polymerization process. One thing is depolymerization. I did explain that it's converting polyester to the raw material, but polymerization is converting the raw material to polyester. And that is a 24/7, 365 process. Happens all the time. Raw material is fed in and polyester comes out. That's the yarn. Let me talk about who its customers are. Well, they are a very diversified customer base. They have customers across 45 countries and 5 continents, and they also have a large presence in India in terms of a customer base. Some of the smaller customers prefer Filatex India. Some of the larger customers look at Reliance Industries, of course, which has a better pricing power, and Filatex therefore targets some of the smaller customers in India. Let me talk about the financials now. In terms of the financials, you're looking at a degrowth in terms of, or rather flatlining in terms of top line. It's been very low growth per se over the last 4 years, the 4-year CAGR that we've taken now this time around. And therefore, it's been unimpressive in terms of growth. EBITDA has in fact degrown over the last 4 years. We've seen a bit of a shrink there. But also remember, FY22 was a higher base where raw material prices were far lower, and therefore it enjoyed that raw material price advantage. But if I look at it from FY23 to FY26, we've seen a bit of growth with regard to EBITDA as well. You look at net profit, it's actually down 12% as a result of the same piece. Also understand, you go through cycles when yarn manufacturing is concerned. So you take on debt as the capex cycle balloons, and thereafter the debt gets repaid. We've seen that cycle play out over FY23 to FY26, as a result of which that has also added or aided profitability upwards between FY23 and 26, FY22 of course being that exceptional year which I spoke about. Let me talk about margin trajectory. It has been choppy. Margins have sank to almost 5%, have now risen back towards the 8% number in FY26. So you want to keep that margin trajectory in mind. Plenty happening on the margin count. They are also trying to generate captive power, which will save some amount on the EBITDA count, which will lift margins by nearly 18 to 20 crore odd. We'll talk a little bit about that, as well as some management commentary which has come through. But essentially, margins will continue to see a lift. That's the expectation net. Let me talk about the balance sheet now. You've got around a 1,500 crore of equity on a 2,000 crore rupee market cap base. So that's 1.3 times book is what this one trades at. Currently, borrowing is low, but if you look at the historical borrowing, FY23 borrowing number, it was at around 300 crore, which was where the borrowing stood at. Currently at 120 crore is the borrowing number. You can see how it's come off. And cash and bank balance also sitting at approximately 50 crore, not bad at all. Clear thumbs up on the balance sheet. But what's important is, where do they fund the capex from going forward? that is something we'll keep our eye out on. Now, let me talk about cash flow. Cash flow has been decent. You've seen good conversion of EBITDA to cash, and therefore no concerns here, as you can see on your screen. No problem. We're just a bit cautious because there are certain receivables which sit in the balance sheet which get unwound in some years, which is FY25, where the payables gave the working capital a bit of a lift, which is why cash flow came through. So you've got that choppiness, but outside of that, you've seen a steady 75 to 80% conversion. Let me talk about return ratios. Return ratios, again, have not been half bad. You've seen an exceptional year in FY22. You want to remove that. But outside of that as well, it's been between 13 to 15%. FY26 is 17%. Can this sustain? Well, all of the capex that they've guided for an EBITDA of nearly 20 to 30% on the capex at the bare minimum. And therefore, this should ideally be sustaining. But we will quiz management and understand it better because it's been choppy and because in certain cycles it's gone down. We've given this a neutral. Also understand return on capital includes the debt that they take on the balance sheet. That's the other piece that you want to continue to monitor because that will influence ROCE. Let me talk about the shareholding now. 60% held by the promoters, no concerns there whatsoever. So we've given this a clear thumbs up. There's FIDI participation as well in small amounts, and then the public holds the balance, which is 28%. Valuations, this one trades at sub 11 times earnings at this point. The range, the 5-year range, is 9 times to 36 times. This is all trailing 12 months price to earnings. And the average is around 18 times. So this trades at a significant discount to the average. It also trades at the lower end of the price range, or the price to earnings range that typically this one has traded at over the last few years. And therefore, that's something you want to keep in mind. Now, let me talk a little bit about management guidance because that becomes important and crucial. The recycling plant commissioning is going to happen in September 2026. Polyester filament yarn expansion is going to happen towards 55,000 tons. Steam distribution capex of 85 crore to generate 65 crore of EBITDA. Automation capex of around 40 crore to happen. Recycling project capex, which is at Ecosys, of around 300 crore to add 75 to 80 crore of EBITDA, which is very decent. Polyester filament yarn expansion of around 235 crore to add 60 crore in EBITDA. That's the estimate, of course. And then you have renewable energy capex of around 30 crore to add 18 to 20 crore to EBITDA, which is again very healthy. Let me bring on board Madhusudan Bagaria, who is representing Filatex India today. Mr. Bagaria, it's great having you. Let me first start off by understanding in the current environment, are the risks elevated with regard to raw material pricing? And how much of that are you able to pass on to your customers? And what do your agreements state in terms of pass-through?
Good afternoon. The raw material prices are elevated at the moment because of the crude being very high priced. And we're not able to pass on fully, but now slowly the demand is picking up. So going forward, I think we'll be able to pass on the balance also. But the main thing is not the prices. The fear that if the war stops and the prices will fall drastically, that is the fear which stops the buyers from buying smoothly as of now. So they are afraid they'll be stuck with the high cost inventory. So that's the problem. It's not the price because the price doesn't make too much of difference in the final product. And we have sold materials at even higher prices previously also. But right now, the scenario is like that the war can stop anytime and then the prices will fall suddenly and the customers will be left with high cost inventory. So they are reluctant to buy. But now seasons are approaching. So I think by end of this month, the demand should come and we should be able to pass on whatever balance we have not been able to pass on.
Do you hold any inventory of the raw materials, PTA, MEG? Do you hold any inventory there? And is that typically part of the business that you do? And therefore, are you able to give that benefit to your customers to continue to buy at lower prices?
We do hold some inventory because, see, we buy almost 50% from local and 50% is imported because there's shortage of both the raw materials. They are not fully available in India. So we do have to import. Yes, we do have a low-cost inventory, but yes, that's why we are able to work at whatever capacity we are working now. But going forward, even the imports will be at a higher price and we will be forced to pass it on.
Okay. And how much of a near-term impact will it have? Say, give us the tenure of the impact and the quantum of the impact on your margins. Or will it not be any impact at all? Will you pass through everything?
No, right now we've not been able to pass on at least 8 to 10 rupees per kg. So if you see right now, our working would be at EBITDA neutral if we compare current raw material prices with the current yarn prices. But since we have some old stocks, so we having some EBITDA positive. But this cannot continue for long. So if the war doesn't stop, I think we'll be forced to pass it on.
Mr. Bagheria, I just want to quickly clarify. By EBITDA neutral, you mean you'll operate at a very, very wafer thin margin. Is that my understanding right?
We are able to cover only the conversion costs at the moment. We're not able to convert our interest or depreciation at the moment.
Understood. And because you have a certain raw material stock already there, you're still able to do maybe a 6 to 8% EBITDA. Am I correct in my understanding?
Yeah, we are able to do. I cannot put a number to it, yes, but we are able to do a small EBITDA right now. But things are very choppy at the moment. Every day we hear different news, and the crude is also behaving very volatile. So it went to as low as 85 a few weeks back, and then again now it's around more than 110. So the volatility is very high, and that keeps the customers at a bay. I mean, they don't want to buy regularly. They have also cut down their production. Even the workers have left. A lot of workers have left to their native places. Even for the downstream customers of ours, even we are facing shortage of workers also. But now I think after 15th May, they will start coming back. So things should cool down by end of this month, and hopefully they should normalize by end of this month.
Workers leaving is part of the cycle, right? There's nothing surprising about that.
It is part of the cycle, but no, this time because of shortage of the gas and other things, they are, I mean, more have left. I mean, the people will leave would be 10-15%, but this time it's around 30 to 40% workers have left. And that is across the industry. It's not for us. For most of the industries, the workers have left.
Right, absolutely. Mr. Bagheria, give us a sense. I want to first close this margin piece. So for how much of inventory, how many weeks or months of inventory do you currently hold?
No, right now we are not too great on inventory. We would be holding anything from 7 to 10 days at the moment. In the raw material side, finished also, we would be having around 12 to 15 days of inventory.
Okay. Mr. Bagheria, I'm going to pause this conversation. I need to slip into a very quick committed commercial. I'm going to come back to you, quiz you a little bit more with regard to the business. But viewers, that gives you a perspective of what's playing out right now. We'll come back, look at the forward-looking thoughts that Mr. Bagheria has, especially with regard to the capex, crucial, 700 crore, adding a large EBITDA to the current base of the company. Stay with us on that forward line. Welcome back. We're in conversation with the management of Filatex India. In fact, we have Madhusudan Bagheria, who is the Chairman Managing Director at Filatex India, still with us. Sir, give us the sense with regard to the FY27 capex. How much of that capex is expected to close? How much should that add to your current capacity? And what will utilizations look like once that capacity is added? What should that add in terms of your top line? Give us a sense.
Yeah, so we have 4 or 5 capex going on. One is the brownfield, which we are adding 55,000 tons of capacity. That should be over by September of this year. And that will add around 60 to 65 crores of EBITDA. And I think we should be able to capture that fully in the second half of this financial year. The second one is steam. Steam would be commissioned by July this year. In the remaining year, we should be able to capture around 70% of the profitability, which we have said. And then next year, FY28, we should be able to capture full. The third one is the Ecosys project. That should also get commissioned by end of September. And hopefully we should be able to capture around 60% in this balance year. And then in next financial year, we should be able to do around 80 to 90%. These are the main three ones which are there. And of course, the renewable energy, as and when I think we expect it to start in October sometime, then that is always full utilization. There is no fallback on that. One thing I would like to correct, you have shown the EBITDA is wrong. It is 346 for the FY26. You had shown it 313, I think.
Okay, I will get that changed. This is FY26 EBITDA of around 346 is what you've done, you've suggested. I'll get that changed. Let me also quickly try and understand in terms of the funding for the capex that you're doing. 690 crore of capex. How do you plan to fund it? Is it going to be phased?
No. We have taken a ECB for 135 crores for the machinery which we are importing from Germany. And in Ecosys, we have taken a 200 crores term loan from the banks. Rest all will be funded through internal accruals.
Okay. And what's the cost of borrowing, sir? Can you give us a perspective?
The ECB, we are borrowing at 0.85 to Euribor, plus Euribor. And local for Ecosys, the cost is around 8.7%.
So it's sub 10% on both. I mean, even with the possible currency depreciation. Even if I were to factor maybe 4% of currency depreciation.
If I hedge 100% ECB, I think we should be close to around 8.25.
Correct. And how much of debt will sit on your balance sheet at the end of this capex, if you can give us a perspective of that?
End of FY27, we should have a total debt of around 360 to 370 crores.
Okay. And that will be your peak debt?
Yeah, that should be the peak debt.
Understood. And with the capacity ramp up, where should your top line go to at full capacity? Maybe FY28?
FY28, I would say we should do anything around 54 to 5500 crores.
Okay, 54 to 5500 crore. And your margins, I mean, of course, right now you're in a difficult position because of everything that's playing out geopolitically. But eventually margins should unwind for you.
See, in a steady year, we should do around anything from 11 to 12% of EBITDA for our Filatex thing. And for the recycling, we expect to do a EBITDA of around 30% plus.
And how is recycling scaling, sir? Can you give me a perspective? Because out of the 5500 crore, can you give me a breakup of how much is recycling? Because Ecosys is where a bulk of the growth is going to come from.
So the recycling top line would be around 400 to 450 crores.
400 to 450 crore, on which you will do a 30% margin.
Yeah, we should do around 30% in the full year when we are running at full capacity.
Correct. And on the existing, where you'll take your top line from, say, 4,000 crore to 5,000 crore, nearly ballpark.
Yeah, so on the Filatex, we should do FY28, we should do around close to 5,000 crore.
Yeah, and that will take your, and you intend to take your margins from the current 8% to 11%. Some of that is obviously cost efficiency, which will play out, but some of it is also because of scale. You'll probably.
It's also because of the raw material availability will become more easy by FY28. Before that, there are 2 PTA plants coming in India, so that should make availability of PTA self-sufficient for India. So that should also reduce some operating cost. I mean, the buying cost in the raw material side. That will help us.
Understood. Very interesting. Of course, plenty to talk about, Mr. Bhagaria. The China factor, the India-US, India-EU being tailwinds, China factor being possible headwind. But, sir, sorry, but completely out of time on this edition of All About Your Company. Thank you so much for coming in and giving us this perspective.
Thank you for it.
All right, and viewers.